And good morning, welcome everyone. I'll jump straight into our presentation. We've been observing for some time now, and it really started in 2018 with the Trump tax cuts. Fiscal activism, there's been a real shift in the backdrop. And it was a result, I think, of the failure of QE. QE stimulated asset prices, but it had it was less than optimal when it came to stimulating the economy. So it led to very wide wealth differentials, populism, then we had Trump, and then we had COVID. And through all of this, what we saw was the response to every crisis was stimulation on the fiscal channel, and also central banks reinforcing that. So central banks normally act in a counter-cyclical manner, and they were reinforcing it, pro-cyclical central bank policy. And it really reflects the fact that we think the central banks are increasingly captive to their political masters. We've really gone down the pathway of losing central bank independence. So we think that volatility weighs on multiples. Out of this, I think you'll also see policy-led winners. That increasingly fiscal stimulus will start to go towards decarbonisation, towards onshoring, and infrastructure projects. We're seeing it, but we're going to see a lot more. So let's unpack what that means for the composition of investment in the economy. So if you go back to 1980, most investment, 70% of investment went into tangible stuff, equipment, structures, as opposed to intangible, which is software and intellectual property. Fast forward to today, and the split is 50-50. Now, we know why that happened. We had the emergence of the internet. We had e-commerce, streaming video on demand, social media. And we also had things like the digitization of the enterprise, the emergence of the cloud. Now, all of those things, the interesting thing about them is some of them led to productivity growth. Not all of them. I don't think Netflix has improved productivity, but the digitization of the enterprise definitely did. Now, what we see happening is that's not going to go away, but the step change is going to come in tangible. It is all of the investment we need to solve for climate risk, to solve for geopolitical risk. And we think it will end up being more inflationary because it doesn't have a big productivity payoff. So the inflation backdrop, we think pressures are there, structural pressures are there. You have this fiscal activism, you have the wage pressure, which is a combination of participation rate having fallen through COVID in the US and in the UK. We also have a big skills mismatch. And part of that mismatch is really the change. And when you change the investment in the economy in a major way, you don't necessarily just all of a sudden get the skills that you need to take that tangible investment forward. You need electrical engineers because it actually is just a super cycle in investment in the power sector. So those skills shortages are real. The Fed is very concerned about the level of wage growth in the US economy, and that's why it's been tightening. Then you have China. China is no longer a low-cost manufacturing hub. We have the aging population in the West. We're losing workers, but we still have to take care of our elderly folk. We have ultimately, we may get some benefit from AI, machine learning. Certainly, will start to deflate some of the service sector. AI will be very powerful, actually, in removing some of the most expensive jobs from the economy. But that is a longer-term trend, and it won't necessarily fix the issue that the Fed has in the medium term. So have we seen this playbook before of fiscal policy being much more active, of central banks having to sort of try and deal with governments and their policies, which ultimately reflected a much more volatile nominal GDP growth era, and we have. It was the 70s and the 80s. And you can see it there on the blue line. Nominal GDP growth went through these big swings, and we know equity markets don't like volatility. It drives up the discount rate and it results in lower multiples. And that's what we saw in that period. The average multiple on the US market on a cyclically adjusted, a CAPE basis, was around 11 times versus where we are today, where we're still at 30 times. So we think there's a real risk that volatility in the economic cycle, and it's already starting. Look at that, you can see that leads to a derating. So it's a good segue to the regional roundup, if you like, on valuations. Europe is interesting. It had the energy crisis last year, and that led to sort of a decline in earnings estimates. You're a fair way into the downgrade cycle in Europe, and at the same time, you're seeing the energy crisis reverse. So not only do you have low earnings expectations, but you have a very low multiple being applied to those earnings expectations, which is the light blue line. Similarly, in China, earnings estimates are down 16%. China's actually had a consumer recession. Now, why? It's because the Chinese policymakers did take a counter-cyclical approach. During COVID, their export sector was booming, and so policymakers sat back and said, okay, let's tighten policy. The Fed's doing our work for us. It's got this very loose policy. Europe's doing our work for us. It's got loose policy. Our export sector's booming. Let's reform the property sector. Let's tighten monetary policy, tighten fiscal policy. Let's save our ammunition for when we may need to loosen. And so you've got low earnings estimates on very low multiple, and you're in the beginning of an easing cycle. So we think both Europe and China can outperform the US economically in the next 18 months. As the saying goes, hope is never a strategy, but we think it is a useful acronym. So it starts with housing, and it's an acronym for sort of understanding how a tightening cycle impacts the real economy. So in the US, homeowners don't normally have a variable rate mortgage. So the buyer who is impacted is the marginal buyer. The buyer who has to pay a higher rate when the Fed lifts rates is the marginal buyer. So that's what you're seeing. You're seeing a real collapse in activity in the housing sector. So that's where the slowdown starts. Then it feeds into orders. Across the economy, that slowing housing activity leads into orders starting to weaken. And then as corporates start to see the weakening in their orders, they start to worry about profits. And if you look at sentiment, CEO sentiment surveys, they're plunging their lows because they know what's coming. They're looking at a profit downgrade cycle. But in the US, unlike Europe and China, it's very early. You're only 5% off your highs on earnings estimates. So we think the Fed actually has to crunch profits if they're going to loosen the labour market, because corporates don't fire people until their profits come under pressure. Employment is a trailing indicator. It's not a leading indicator. Housing's the leading indicator, employment's the trailing indicator. But you're going to get there. You'll get there in the next 18 months. We think you're really about to see it start happening right now. Employment will we think you need to get unemployment in the US from where it is today, 3.5, to at least 5.5, to take the pressure out of the wage market in order to get services inflation under control. Services are 70% of the inflation basket. So where does it leave us in regards to selection? Where do you place your medium-term investments today in this market? One idea would be to go back to yesterday's winners because they've derated, and in some cases we think that is justified. On a selective basis, we're open to that idea. But in the case of Apple and Alphabet, we're quite concerned. The mega cap tech space, there's a lot more dispersion. Apple is the stock that is actually trading at its all-time high relative valuation. And profits this year are going to go backwards at least 1%. We think quite a lot more. Now, when you think about the average iPhone user, the handset of an iPhone user is on average 3 years old. If you look across the Western world, non-iPhone users, that number is over 5. So what does it tell you about iPhone users? Well, probably it's a relatively wealthy demographic. They seem to be quite impatient when it comes to their technology. Maybe they abuse their phone a lot, I'm not sure. But we think that user is also the sorts of jobs that are potentially under threat. Like in this unemployment cycle, tech is already right-sizing. Wealthy jobs are starting to be destroyed by Fed policy. So we think there's a lot more consumer sensitivity in Apple than the market thinks, and at 25 times, that's not priced. Look, in the case of Alphabet, the big concern with Alphabet is the emergence of AI being applied to search. Microsoft is looking at search and it's simply saying, well, we can give you a better answer with an AI-powered search engine than Google can. Now, the problem is that query under AI costs you 10 times as much in terms of compute cost to a current search query. So it's classic innovator's dilemma. If Alphabet responds and switches on its AI engine to start to answer your search queries, it's just going to cost a lot more. Microsoft has nothing to lose, everything to gain, and Google has everything to lose. So we think the margin of error around Alphabet is definitely starting to widen, and even though it has derated, unlike Apple, it has derated, we remain on the sidelines. Where we do think there's a great opportunity from a pragmatic value to invest and take advantage of this big structural change, it's always about paying the right multiple for the type of growth that you're gaining exposure to. It is in companies like TSMC, who is the arms dealer to all of this activity. All of the chips that are powering this AI revolution are supplied by NVIDIA via TSMC, who is doing their manufacturing. It's also a great way to play the onshoring, the CHIPS Act that has been passed in the US, which is basically a bribe by the US government to TSMC and Samsung to come and build their fabs in the US. Because they wouldn't do it without a big investment incentive. There's no way, because the cost of manufacturing in the US will be a lot higher. So we think it's, on the 16 times, it's a pragmatic value way to play this structural growth opportunity. And then you come to Oracle and Microsoft. Success in this part of the market will depend on your ability to deploy compute power cheaply, and all the large cap tech stocks have that, and the quality of your data sets. And as we know, Oracle has very good corporate data sets, being an ERP, the provider, one of the leading providers of ERP and database. And Microsoft knows a lot about you as a corporate user of their platforms. So they will be able to incorporate a lot of AI into their software and launch new services. And at the same time, Microsoft is going to go and try and take a bigger part of the search market. Now, that will be harder because Google is a formidable competitor, but we don't need that to happen. That's a free option in our investment thesis. So let's shift to a situation. We're no longer discussing yesterday's winners, where we know we need to be selective based on what's happened in previous cycles, similar to what we observed coming out of the big tech bubble in 2000. It's also looking for the new winners. And Siemens Energy, I think, is a great example of that. What you're seeing with the euphemistically described Inflation Reduction Act in the US, which should be more accurately titled the Inflation Reacceleration Act, is $400 billion of investment targeting the energy transition. And why we say 400, but actually no one really knows, because it's open-ended. It's actually production credits. it's investment credits, it's manufacturing credits, and there's no cap. And renewables are already competitive in Midwest of the US. They're very competitive in the sunny parts, the windy parts of the US. You don't need these incentives to encourage utilities to invest. It's actually happening anyway. So it will really accelerate the market opportunity. And Siemens Energy, we describe it as the Swiss Army knife, more accurately, the German Army knife, Swiss Army knife of decarbonisation. It touches on wind turbines, leading manufacturer of wind turbines, leading manufacturer of high voltage transmission equipment. It also solves for hydrogen. And look, this investment cycle is genuinely structural. Like, even if you just take the reality of having to decarbonising the existing power grid, if you want to remove hydrocarbons, we need to resize the power grid by 3x. It's very hard for investors to get their heads around that number, and that's why we think this is a great opportunity to buy. You don't need to go onto the lunatic fringe. You can buy very sensible companies run by sensible people on sensible multiples because they were perceived to be cyclical companies that are transitioning to a structural growth profile. So just in summary, we need to position for a real change in regime, fiscal activism, a super cycle in tangible investment. We need to be selective around yesterday's winners. We really should be focusing on tomorrow's. And take advantage of the current valuation divide in markets. There are some very attractive choices. And as always, a pragmatic value approach is in this environment is about finding resilient businesses that offer us a margin of safety and are really well placed to deal with this economic volatility, and looking for opportunities to protect our investors via hedging out tail risks when we see that sort of risk when it's very cheap to do that. So thanks for listening.